Welcome back, traders, to Module 3, Lesson 3, Valuation. In this lesson, we're going to break down the concept of valuation and how it helps us assess the market beyond just price movements. Understanding whether an asset is over or undervalued is a crucial part of successful trading. It allows us to identify inefficiencies in the market and spot high probability opportunities before the crowd does. To do this, we'll introduce you to our valuation indicator, a powerful tool that helps quantify these imbalances and gives us an objective way to evaluate market conditions. By the end of this lesson, you'll know how to use the evaluation indicator to fine-tune your trading bias, recognize when price is out of sync with value, and make more informed trading decisions. Let's get started. Let's start by addressing an important concept. Price as a measure of value is misleading. Price is relative, not absolute. By itself, price doesn't tell us if an asset is expensive or cheap. Markets are in constant motion, with prices shifting based on new information, sentiment, and macroeconomic factors. If we only focus on price, we're missing a key piece of the puzzle: value. Price simply tells us what an asset is trading for, but it doesn't reveal whether that price is fair compared to its relative worth or the broader market context. This relativity is why price is such an incomplete measure. For example, how do you compare oil to gold? How do you compare one stock to another? If we look at price alone, we would be completely misguided. Oil might trade at $80 a barrel and gold at $1,900 an ounce. But does that mean oil is cheap or gold is expensive? Without a way to relate those prices to one another or to their historical or relative value, price doesn't tell us the full story. This is why understanding valuation is so critical. Valuation gives us a framework to determine whether an asset is overvalued or undervalued, allowing us to see beyond price and make smarter, more informed trading decisions. By focusing on valuation rather than price, we gain clarity and avoid being misled by short-term fluctuations. To drive this point home, let's look at a real-world example to showcase how perception of what is cheap and expensive can shift over time. Let's take a closer look at this chart to visually demonstrate why price is relative and why terms like expensive or cheap are merely snapshots in time. This is a chart of Tesla's stock price. At first glance, today's price of around $345 might seem expensive, especially if you've only followed Tesla's price over the past few months. However, if we compare it to its all-time high in 2021, when it was trading above $400, today's price suddenly looks cheap by comparison. It's worth noting that Tesla also underwent a stock split, meaning depending on when you last looked at Tesla's price, it might seem even cheaper. This highlights how corporate actions, in addition to timeframes, can dramatically alter how we perceive price. This example makes an important point. Whether something is considered expensive or cheap depends entirely on the timeframe and context we choose. Without broader comparison, price alone doesn't give us the full picture. That's where valuation comes in. Instead of relying on an arbitrary price level, valuation provides a structured way to assess whether an asset is generally over or undervalued, not just in comparison to its past, but also relative to broader market conditions. Let's explore how exactly it is done. To determine an asset's true value, return to our valuation indicator, which compares in real time an asset's price to key economic benchmarks, helping us assess whether it's overvalued, undervalued, or fairly priced. The three critical benchmarks we use are: first, US Treasury notes or interest rates; second, gold; and third, the dollar index. By analyzing these comparisons, we move beyond standalone price movements and gain a clearer, more objective measure of value. Let's take a close look at each of these three benchmarks to better understand how and why they are used. Each benchmark represents a key economic force. Number one, US Treasury bonds. Long-term bonds, that being 25 plus years, are the global benchmark for risk-free returns. They are considered risk-free because they are backed by the US government, the most creditworthy borrower in the world, making them the foundation for measuring returns across all asset classes. In addition, bonds represent the benchmark interest rates, a critical element of monetary policy that has a substantial impact, especially on the stock market. Number 2, gold, a historical store of value, often used as a hedge against inflation and currency devaluation. Considered a safe haven, benchmarking an asset versus the price of gold helps us understand how potential risks are priced in. Number 3, the dollar index. As the global reserve currency, the US dollar is the denominator for all major currency pairs and the international pricing standard for commodities like oil, gold, or wheat. Its strength or weakness directly impacts assets' valuation worldwide. By analyzing how an asset performs relative to these 3 benchmarks, we move beyond price alone and gain a deeper understanding of its true value. It is important to point out that the valuation indicator is designed to work on any asset, no matter the market. However, as we will later see, sometimes one benchmark works better than others for specific asset classes. Let's now take a moment to revisit our Tesla price chart to see how valuation enables us to better answer the question whether Tesla is currently expensive or cheap. In the next slide, we'll dive deeper into how these benchmarks work together and why they are so effective for assessing valuation. In this chart, we've added the valuation indicator at the bottom. The red and green lines highlight moments when Tesla's valuation relative to interest rates, the long-term US Treasury bonds, reached extreme levels of either over or undervaluation. Green lines mark points when Tesla was undervalued relative to the interest rates. Each time this happened, we saw a subsequent price rally. Red lines mark points when Tesla was overvalued, often preceding a price correction. So is Tesla's current price expensive or cheap? Without valuation, answering that question is purely subjective. By using valuation, we however gain critical context. The indicator shows Tesla approaching an overvalued extreme, slowly nearing the red line relative to interest rates. This suggests that while Tesla's price has been climbing recently, it may be nearing a point where the market considered it expensive, in context causing the stock to sell off. This highlights the strength of valuation. It shifts us from subjective judgment to data-driven insights, helping us make informed decisions in line with broader market dynamics. By incorporating valuation into our analysis, we can move beyond the ambiguity of standalone price and see Tesla's price in the context of its macroeconomic benchmark. Let's quickly summarize why valuation is such a critical part of our analysis and trading strategy. It prevents misjudging market opportunities by moving beyond standalone price, helping us avoid chasing overpriced assets or overlooking undervalued ones. With valuation, decisions are fact-based, not driven by speculation. It filters out noise, cutting through the short-term market fluctuations and sentiment. Instead of getting caught in the daily price swings, we focus on meaningful comparisons to stable benchmarks like interest rates, gold, and the dollar. It encourages a strategic perspective, shifting our mindset from reactive trading to long-term analysis. Valuation helps us assess the bigger picture instead of simply following short-term momentum. It's easy to backtest and validate because it's based on objective data. By analyzing historical trends, we can refine our approach and ensure our strategy is built on proven insights. Finally, valuation enables us to predict if a market is ripe for a correction, but not when or where it will happen. It signals when an asset is fundamentally over or undervalued, but we still need additional tools like technical analysis and seasonality for precise timing. Valuation is a powerful tool that keeps us grounded in reality, helping us make clearer strategic decisions instead of emotional ones. How do we use the valuation tool in our trading routine? Valuation serves as our primary tool for infinite markets, like stocks and indices, where there are no defined limits to supply or demand. In these markets, it helps us determine whether an asset is fundamentally over or undervalued or fairly priced, providing a clear directional bias. For finite markets, like commodities and FX majors, Valuation plays a secondary role, complementing the insights we gain from the COT indicator. Together, these tools allow us to develop a more nuanced understanding of market behavior and trends. Similar to COT, valuation helps us avoid emotional or subjective decision-making by providing a fact-based bias. This bias, whether bullish, bearish, or neutral, forms the foundation of our strategic approach to any market. It's important to remember that valuation tells us if a market is ripe for change, but not when or where the change will occur. For timing and execution, we rely on supply and demand to identify entry and exit points and ensure precision market positioning. Let's go over how to configure the valuation tool based on the asset class you're analyzing. This guide will help you select the correct benchmark and timeframe settings for accurate valuation. Feel free to take a screenshot for reference. For equity indices and stocks, compare valuations against interest rates using a 13-day look-back for short-term analysis and a 30-day for long-term trends. For currencies, our FX majors assess valuation against the dollar index, applying a 10-day look-back for short-term moves and 30 days for broader trends. For precious metals, use gold and the dollar index as benchmarks, except for gold itself, where silver serves as a substitute. Stick to a 10-day look-back for short-term trends and 30 days for long-term perspective. For energies like crude oil and natural gas, compare them against both gold and the dollar index, maintaining a 10-day look-back for short-term movements and 30 days for longer-term trends. Finally, for agricultural commodities, valuation is measured against the dollar index using the same 10-day short-term and 30-day long-term look-back settings as energies. By configuring the tool correctly, you ensure that valuation insights align with each asset class's key economic drivers. Let's now explore how to apply this in practice. Hi, welcome back to another practical application. It's Clemens again, and today I want to talk to you about valuation. So let's head over to the charts, learn how to load the indicator, what settings to look out for, and then do some practical applications in terms of how to best use it in your day-to-day trading routine. So right now, I'm already on Campus Fund, our trading platform. It runs on TradingView, so let's dive in. I've selected the Australian dollar for this example, but like I said earlier in the lesson, valuation works on any asset class. So let's load the indicator by clicking on Indicators and then selecting the Campus Valuation tool. Click on it once and give it some time to load in the background. Before you start your analysis, always make sure that you're on the right time frame. The valuation indicator works best on a daily time frame, like I've selected up here. Now, when the indicator loaded, you probably see 3 lines, all in different colors, and a whole bunch of numbers. And it might be a little bit overwhelming. But don't worry, that's what this session is for. We're going to go through everything step by step, so it makes sense. First up, before we start using the indicator, let's go over the settings, because that's where you can play around a little bit, but it also makes it so much easier for you to understand it. To open the settings, just double click anywhere on the line, and this window pops up. Let's start with our input section. Up here, you see 3 different reference symbols. And remember from the lesson that we use 3 different economic benchmarks to compare in valuation model. Long-term treasury bonds, so our interest rates. This would be symbol number 1 here. Then symbol number 2, which is gold. And third, the US dollar index, or DXY. Below that, you can trigger whether or not you would like to show each of these symbols in the indicator, or you can select or unselect certain ones. So right now, all of them are selected, and that's why you see 3 different lines down here. Before I go over the rest of the setting, let's quickly go to Style so that you understand what the colors mean. Sim1 div here in the settings refers to the reference symbol number 1, our interest rates. And we use them in blue. You're free to use whatever color you want, but over at OTC and most of our mentors, they use blue. So if you leave it like this, it just makes your life probably a lot easier to follow along. Then we have symbol number 2, which is gold, which we colored in yellow. And third, we have symbol number 3, which is the DXY, or in other terms, the dollar index, in pink. Then we have the upper and the lower threshold. These refer to bullish, undervalued, or bearish, overvalued extremes. Let's go back to the inputs for a second, because there's one last thing that we need to talk about. That's the ROC length. Right now it's set to 10. And since we're on a daily chart, this means it takes the past 10 days of data from these reference symbol as a basis to map out the valuation. For almost all asset classes, 10 days is the preferred ROC length for short-term valuation. With the exception of stocks and indices, they're changing from 10 to 13 makes a lot more sense. It just gives you more accurate results. And we will do that later on in an example. Since we're on a currency right now, let's stay with 10. Also, if you want to have a more long-term outlook on valuation, you can change this to 30. So 30 days being 1 month. Now, because we're looking at a currency, we learned already in the lesson that for currencies, it makes most sense to look at the valuation versus the dollar. So let me go ahead and hide the valuation versus gold and the interest rates just to declutter the chart a bit and make it less confusing. So I'm going to uncheck symbol 1, which is the blue line or our interest rates. And I'm going to uncheck symbol 2, which is the valuation versus gold. So that leaves us only with the dollar valuation. Now, let me zoom out a little bit and show you just how powerful this and accurate this tool is. I'm going to grab a line here. I'm going to place it every time the indicator showed us an extreme overvalued reading. And then we're going to have a look at what price did. So, for example, we recently have been extremely overvalued. So I'm going to put a vertical line right here. I'm going to do it again here, 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 and here. And let's do 2 more. For example, here, and we can also pick this one, right? So you've seen these are recent examples where valuation went above the red line, indicating that the Australian dollar relative to the price of the dollar itself or the dollar index itself was overvalued. So we would then expect a price correction. And let's see if that's true or not. So I'm going to make the chart a little bit bigger and easier to read. Let's start with our last example, which was actually just a couple of days ago on the 27th of Jan. Notice how as soon as we started to become overvalued, price started to slow down in its uptrend and actually started to reverse. The same thing happened here back in September. Once we touched the overvalued reading, price started to move sideways before eventually collapsing. A similar thing happened here. There's an important teaching point here, and that's why I selected this example. See how we were actually already overvalued here, but price continued to rally a little bit higher before it ultimately collapsed? That's a good reminder that the valuation tool is not a timing tool. It's a fundamental bias tool. So what do I mean by that? Back then, it showed us that the market is ripe for a correction, but it couldn't really tell us when. We need supply and demand for that. So price continued to rally until it hit the quality supply zone, and it then started to collapse. So that's why we never act just on the indicator reading by itself. We always take it into consideration among other tools and obviously our technicals. But you can see that even here, in this example, while we remained overvalued, price eventually started to collapse. Then let's look at the last 2 examples. So here again, price was overvalued. We got the sharp decline from here. And even here, all the way back in May, as soon as we started to become overvalued, the subsequent days, price started to collapse. So you can see that the indicator is very accurate. And every time we are in an extreme, so in our example right now, in an overvalued extreme, we can expect a pullback or a sharp decrease in price. Now, there is no way of knowing from the indicator itself whether or not the decrease or the price correction is going to be imminent and how strong the correction will be. But it shows you that the probability that a correction will happen is very, very high. And that gives us a data-driven bias. So rather than being emotional and seeing price rallying up and trying to get into a long and chasing price, we can turn to our indicator and see if this rally has legs to it or if it's nearing a turning point and will end soon. So this here allowed us to get actually ahead of the crowd and position ourselves in a high probability, low risk setup to short the market, which then eventually happened. Now that we've looked at a currency, let's go to a stock where we use a little bit different settings and see how we can use the indicator also with a different reference symbol. So let's go, for example, to Apple. So right now we are on Apple. Again, we are on a daily chart. Because we're looking now at a stock, we should look for a valuation versus interest rates rather than the dollar. And remember, we need to change our ROC length from 10 to 13 to get the optimal results. So I'm going to do that now. I go back into the settings. I'm going to unselect reference symbol 3, which is the dollar. And I'm going to use reference symbol 1, which are the interest rates. And down here, I'm going to change the ROC from 10 to 13. Now let's again do a little bit of backtesting. Let's this time have a look at what happened whenever the indicator showed us an undervalued reading. So I'm going to zoom out a little bit. I'm going to take the vertical line and just place it here to undervalued extremes. For example, here, here, and we can do one more here. Now, let's see what happened to price when we were undervalued. So you can see Apple here was in a pretty strong downtrend actually, and it sold off quite substantially. But as soon as we became undervalued, prices started to form a bottom, then eventually started to rally. The same thing happened here back in August. The price actually gapped down, so the price pressure towards the downwards move was pretty strong. But we became undervalued, and then we got this massive rally out of it. Similar here, we were in a very long downtrend. We became undervalued, price started to slow down, and then eventually started to rally. Same thing happened here, and of course here. I just want to point out something on this particular example, because if you look closely, you might notice that we are actually not yet in an extreme. We're not yet really at or below the green line. And that is okay. When it comes to valuation, it's always important to remember that while these lines provide very clear reference point in terms of extremes, we can also look at the data in isolation and compare it or reference it to previous readings. So what do I mean by that? If you look here, we used to be extremely overvalued, and then we got this sharp decline in valuation. So while we were not yet in a bullish extreme by being completely undervalued, the significant shift in valuation would be enough for us to say that we are now fundamentally biased to the upside because of this rapid change in valuation. So we don't always need to be in an extreme. It helps, and it's even more powerful. But even if you're close by it, as long as there's a significant change to previous readings, that is okay too. With that, I want to close this practical application. By now, you should know how to load the indicator into the charts, how to play around with the settings, and how to apply it on any asset class. Again, remember, it's not a timing tool, but it is a tool that gives you a fundamental bias. Rather than emotions, let our indicators guide you in your trading decisions. All right, this concludes this practical application session. You should now feel confident to load the indicator into the chart and apply it on any asset class. Thank you very much for joining. Let's wrap up by reinforcing the key takeaways from this lesson and the role of the valuation tool in our trading strategy. Our approach is straightforward. We aim to buy undervalued assets when they align with quality demand zones where prices have a higher probability of rising. Likewise, we sell overvalued assets when they reach quality supply zones where correction is more likely. The role of valuation varies depending on the market type. In infinite markets like equities and indices, valuation is the primary tool for determining a directional bias, whether bullish, bearish, or neutral. In contrast, for finite markets such as commodities and the FX majors, valuation plays a secondary role, supporting insights from tools like the COT report. Here, it acts as a confirmation tool to refine entry and exit points. To maximize effectiveness, the valuation process must be tailored to each asset class. Whether comparing stocks to interest rates, currencies to the dollar index, or commodities to gold, using the correct benchmark ensures more accurate and reliable market insights. In summary, valuation bridges the gap between the price and value, keeping our decisions objective, data-driven, and free from emotional bias. By integrating the valuation tool into our strategy, we sharpen our ability to anticipate market moves with confidence and precision. And remember that every week we host live practical application classes focused on our proprietary indicators. So, if you want to learn more about the valuation tool, or if you have any questions, then join these sessions to ask one of our mentors for help. Let's now move on to our next lesson. See you there.